Guys, we're back. So I know that we're zooming through and there's a lot of stuff on here. Please take your time to digest it. And let's again go through examples. Today we're going to go through the covered call. All right, so this one is super duper popular, especially for retirees or anybody looking to generate income on a monthly basis, but you're willing to give up a defined upside. So what do I mean by that? So we need to go through the scenario because these graphs, if you haven't seen them before, they're confusing until you really get a grasp of them. So let's start with the scenario first, right? So here's my example, right? I buy 1,000 shares of SPY. This was at 439.55. This is something I really did, real life. So no fake news here. So what I'm going to do is sell 10 call contracts. Remember, there's always a 10 to 1, right? So remember, one contract was equal to 100 shares, right? So this time I did 10 contracts, and that was 1,000 shares, right? So a little bit steeper risk reward scenarios. But again, these are all just scalar values. You can do this with any number. You can do this with 12 contracts or 4 contracts or 20 contracts. These numbers are nice and round, right? So it's pretty easy to explain it. So we can see that if I buy 1,000 shares, I'm going to sell 10 call contracts, right? You might be like, wait, I remember the call looking like this, right? Well, when you combine it with owning 1,000 shares, you get this diagram right here. Okay, and let's break this step by step. All this dotted line is saying is, hey, this is what would have happened if you just owned the stock by itself, right? So it's nice to see that guy, right? Like if the stock went up in value, I make more money. And if it went down in value, I lose money, right? Pretty common for most to understand. And so I just put that in there as a display of what we're kind of doing it against, right? So why would I use a covered call? Why would I not just own the stock? What are the pros and cons, right? Because there's always good markets and bad markets for any strategy. So let's go through a couple of main points. So here I'm selling 10 call contracts at $444 and $415 per contract, right? So again, remember if you multiply that, that's times 100 shares. So for each contract, it's 400 per contract, right? And then I multiplied that by 10 this time, right? So it's $4,150, right? That's this guy over here, right? $4,150. That's going to end up being my max profit, or I don't want to, it's going to be the max profit I can make off these calls because this time I am selling them to the world, right? I did not buy them. So last time we were buying them down here, hoping they would go up. This time I'm selling them up here, hoping that they'll go down, essentially, right? So I just inverted the ability of the call contract. And what does that do? It gives me money up front, right? So when I sell these guys immediately to my account, I get $4,150. That's nice, right? So I could use this money to buy other stocks, other positions, whatever I want, or I can just pocket the cash. But what is against me at this point? This is also a month out, right? So this was like July, I think 21st, right? And again, today was 6/20/23, just to keep those in context. So we're a month out, and I'm saying, hey, I don't think the market is going past 415, or I don't think the market is going past 444, right? So today the market is at 439.55. I don't think it's going past 444. What is the orange? The orange, per usual, is just me thinking out loud. And to the right of this line, right? So I put the orange to the right over here. I'm bummed I didn't make as much as I could have, but I still keep the 41.50. Don't be greedy. Okay, so what does that mean? If the stock, right? So what am I comparing it against, right? If I just own the stock, I got this line, right? And obviously, if the stock goes to like 500, right, I gave up a lot of money because I am flatlined here at the calls. That is the most I can make on this guy. The chance that something blows up to 500 from 400, especially the S&P 500, is rare. Notice I use the word rare or non-probabilistic, but it can happen, right? And no problem, I'll eat that. But I say don't be greedy in that it also provides this nice padding, right? So if I focus on this right here, when I sell the call contract, right, and I get this 41,500 directly to my account, I can essentially, in my mind, subtract that off of how much the stock would have broke even right here, right? If it goes down to 439.54, I've essentially lost 1 cent. No big deal. If I shift that, right, I get this shifted because I have the 41.50 cushion. And now that I have that cushion, I'm essentially subtracting it off there, right? So that's where this guy is coming from. 439.55, and then I get 435.40 is now my cushion. So that's nice, right? So I get more of a break even before if the stock goes down, right? Anyone else, if they're just owning the stock, they're just going down right from here. I don't start going down until I go from over here. That's a nice benefit. The the next point is like what's my worst case scenario, right? Oh my God, it looks like I could lose everything. Well, so could you with a stock, right? I hate when people go when they read these credit spreads and they go, I could lose all my money. Dude, you could lose your money no matter what, right? So if you just own stocks, they can go to zero. If the S&P 500, which is essentially what most people use as their proxy of America's stock economy, the S&P 500 is the 500 largest companies, right? We've got bigger problems, right? If that goes to zero, right? We're bankrupt and it's Armageddon. So we're not too worried about that, but I've bought myself some cushion. And let's say that the stock just sits right here at 439.55, right? It goes nowhere. That's fantastic for me. I got 4,150 bucks for doing nothing, right? It's a month goes by, right? So 30 days, I just got to wait 30 days. The stock doesn't move at all. I made myself 4 grand. What's the downside of that, right? If, for example, the stock again rockets through, right? I'm still keeping the 4150, but I gave up something up here, right? So again, if the stock had gone to 500, I'm not making that money, right? So I'm saying don't be greedy. I didn't lose any money. I'm just not making as much as I could have at that time. So the best scenario, right? The max profit is if the stock goes up right to my strike price, right? So my strike price is this 444 right here. If I'm right here at 439, so my stock approaches and stops right on this spot right here, which I color coded. Here's my max profit, and here's how I calculate it. I own, again, 1,000 shares of the stock, right? So the stock itself, I made 444 minus 435. And again, remember, this is all times 1,000 shares, right? So I make 4,450 bucks from the stock. The call expires worthless, right? This is me, again, I sold the contract. I did not buy the contract. Expiring worthless is what I want. I want it to not go past that, okay? Because then I don't have to give away my shares. We can get into that later, but I'm making the 415 times 1,000, and essentially I'm making this 8,600. Whereas if I had just owned the stock, remember, if I had just owned the stock by itself, no call contract, I make 4,450. Again, good number. I like making 4 grand doing nothing, right? I definitely like making 8,600 doing nothing. So that's a nice part. But again, there's the pros and cons if the market's going to rocket through. Let me know if you have any questions. I know that this is a little bit more advanced than just the call or just the put, and we'll get into more and more advanced strategies. Pause the video, read the diagrams. I'll try to do better explaining as we move forward. Thanks, guys. Appreciate your time.